Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of corporate finance. And today we're diving into Agilent Technology's latest annual report to see if they're really as good as they claim. Get ready, because this filing has some surprises hidden within its pages. And we are going to decode them for you. Before we jump into the numbers, if you love getting these clear, no jargon explanations straight from the source, make sure you are subscribed. And hey, we've got a fantastic community over on Discord where we break down these reports together even further, so join us there too. Link in the description. Let's start with Agilent Technologies, Incorporated. They're a big player in the life sciences, diagnostics, and applied markets, basically providing tools and services for laboratories. Think of them as the company that helps scientists make discoveries and doctors get accurate diagnoses. They announced a reorganization in November of 2024, bringing together some divisions and renaming others with three main segments now: life sciences and diagnostics markets, Agilent CrossLab, and applied markets. This is pretty common for big companies as they adapt their structure to stay competitive. Now, let's get to the juicy part, the money. For the year ending the 31st of October 2025, Agilent brought in $6.948 billion in net revenue. That is a 7% increase compared to the previous year. This growth was seen across all their main business areas and in most of the markets they serve. It is good to see they're growing, especially after a tougher year in 2024 when their net revenue actually dropped by 5%, totaling $6.510 billion. That decline was mostly in their life sciences and diagnostics markets and applied markets areas, likely due to customers holding back on spending for big equipment. When we look at their net income, it was $1.303 billion in 2025, a slight increase from $1.289 billion in 2024. They saw some nice tax benefits in 2025 that helped boost that number. In 2024, cost-saving efforts and higher interest income on their cash played a role. Let's break down where that revenue comes from. Product revenue, which includes instruments, software, and consumables, went up 6% in 2025 to $4.944 billion. This growth was thanks to their contract manufacturing services, liquid chromatography equipment, and consumables. However, they did see a dip in their cell analysis and vacuum businesses. Product revenue in 2024 had dropped 7% compared to 2023, mainly in liquid chromatography, mass spectrometry, and cell analysis areas. This shows how sensitive these markets can be to customer spending habits. On the other hand, their services and other revenue, which covers things like repairs, maintenance, and software support, grew 9% in 2025, reaching $2.004 billion. This part of the business is generally more stable, less affected by the ups and downs of the economy compared to selling big equipment. Services revenue actually grew 3% in 2024, showing its resilience. Looking at their segments, life sciences and diagnostics markets, revenue jumped 11% in 2025 to $2.726 billion. A significant part of this growth came from their BioVectra acquisition and strong performance in their pharmaceutical and diagnostics businesses. But remember, this segment saw a pretty big drop of 11% in 2024. The Agilent CrossLab segment, which handles services and consumables across the whole lab, saw a 6% revenue increase in 2025, reaching $2.908 billion. This segment has been growing steadily. Revenue increased 3% in 2024. And finally, the applied markets segment, which focuses on instruments and software for analyzing substances, grew just 1% in 2025 to $1.314 billion. This segment declined 7% in 2024, showing it is more susceptible to market pressures. Now, let's talk about margins. Their total gross margin, which is basically the profit they make after accounting for the direct cost to produce their goods and services, was 52.4% in 2025. This is down from 54.3% in 2024. The filing says this dip was due to higher tariffs and shipping costs, a less profitable mix of products, and increased wages. This is a key warning sign. Margins improved significantly in 2024 compared to 2023, partly because they had some big one-time charges in 2023 from exiting a business. Interestingly, their spending on research and development decreased 5% in 2025 to $455 million. This drop was mainly because they had fewer restructuring expenses related to workforce reductions compared to the previous year. Selling, general, and administrative expenses went up 9% in 2025 to $1.709 billion. This increase was attributed to higher spending on company-wide improvement projects, corporate infrastructure, and variable pay. Taking all this into account, their total operating margin, which is the profit from their core business operations, decreased to 21.3% in 2025 from 22.9% in 2024. Again, those higher costs and a less favorable mix of products are impacting their profitability. Looking at their cash situation, it is generally strong. They had $1.789 billion in cash and cash equivalents as of the 31st of October 2025, up from $1.329 billion the year before. This means they have a good amount of flexibility. They're actively returning money to shareholders. In 2025, they repurchased about 3.4 million shares of their own stock for $425 million. This is part of their ongoing effort to manage dilution from employee stock plans. They completed their 2023 repurchase program in September 25 and have a significant amount, about $1.9 billion remaining on their 2024 repurchase program. This shows confidence in their own stock. They also have a significant amount of debt. As of the 31st of October 2025, their total senior notes outstanding were $3.030 billion. They issued new notes in 2024, including $600 million in 4.2% senior notes due in 2027 and $600 million in 4.75% senior notes due in 2034. They also reclassified their 2026 senior notes to short-term debt, meaning that roughly $300 million needs to be paid back within the next year. This is something to keep an eye on. And finally, their net income per S-Hair. Diluted earnings per S-Hair were $4.57 in 2025. This is a steady increase from $4.43 in 2024 and $4.19 in 2023. This basically shows that their profitability on a per S-Hair basis is moving in the right direction. Now, let's get into the risks. Companies like Agilent are always exposed to a ton of potential problems. Economic downturns are a big one, which can hit their customers spending hard. They also face risks from doing business internationally. Think about currency fluctuations, tariffs, and political instability. The report specifically mentions how changes in tariffs and trade policies, particularly those involving the US and China, have increased risk and uncertainty for their future. While they believe they can largely offset these costs by fiscal year 2026 through supply chain optimization and price adjustments, it's a constant balancing act. They also highlighted the potential impact of government funding cuts, especially for customers who rely on US federal government money. If those agencies have less funding, it could directly affect Agilent sales to them. And like many companies today, cybersecurity is a major concern with risks of data breaches and the need for constant vigilance. So, what is the overall story here? Agilent Technologies is a solid company with strong recurring revenue from its services and consumables business, which helps cushion the blow from slower equipment sales. Their acquisition of BioVectra is clearly a big growth driver for 2025, boosting their life sciences and diagnostics segment. However, the pressure on their gross margins due to rising costs and tariffs is a real concern that could eat into their profits if not managed carefully. Their R&D spending dipped slightly, which is something to monitor, but their overall financial health seems sound with healthy cash reserves and active share repurchase programs. The upcoming debt repayment on their 2026 senior notes is a manageable item, but it is a reminder of their leverage. They are navigating a complex global environment with regulatory changes and economic uncertainties, but their diverse business model and strategic focus on key growth markets seem to be serving them reasonably well for now. What is your take on Agilent's future prospects based on these numbers? Do their cost pressures worry you, or do you think their growth strategies will pay off? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and consider subscribing for more deep dives into corporate filings. And don't forget to join our Discord community, linked in the description. To continue the conversation, thanks for watching and we'll see you in the next video.